Hey everybody, Chuck Barone here. Tuesday, September 6, 2022. After a nice 3-day weekend, it was really a good one. Hope everybody enjoyed their time away from a lot of seriousness, these crazy markets, a crazy government, a crazy Federal Reserve, and a crazy freaking world we're living in here. We got a lot of stuff to go over today, guys. A very busy day and a very interesting week coming up. First, I just want to thank everybody real quick, as always, for supporting the show. Your likes, you're watching the videos, your questions and comments, and all of you people who support us every day, especially those who kicked in a few bucks last week through our weird impromptu little fundraiser. We appreciate your guys' generosity. It means the world to us. I hope we're going to deliver for you guys and help you get through this big storm coming up. In the markets today, not a great day in the markets again, guys. These markets now are adjusting to the new reality. Stocks again down today across the board. The futures this morning before the market opened looked like the markets were going to be up. Then the bond market tanked pretty hard, driving stocks down with it. And that's really the news of the day in these markets, guys. The bond market just having a conniption. The 10-year sitting at 3.34%, inching back up higher toward that 3.5% it was sitting at. What's interesting is the 2-year sitting at 3.49%. So now we got a real narrowing between the two, where it was almost 40 basis points spread between the 2-year up here and the 10-year down here. Now it's only a 15 basis point spread. This 10-year is catching up like crazy. This is not bode well for the stock market or people's credit card bills or mortgages or anything else relying on this 10-year. And I will talk a little bit later about the first bond bear market in a generation. So the bond market, horrible. The dollar, what can I say? It's still crushing it. Actually over 110 on the dollar index. I mean, this is just putting incredible pressure on everything worldwide. Great time to be spending dollars somewhere. It's helping us with our trade deficit. We'll see where that comes in. That's one of the things we'll be getting tomorrow. We'll see if the strong dollar helps us with some of our imports. It's just there's no other currency coming close to this right now. I just wish it was this strong in the supermarket, because we see the prices of everything going up around this country, from the most simple thing, paper plates, man. Wow, I had to pay $22 for paper plates the other day. It's just bananas. But anyway, strong dollar putting pressure on metals again. Down day for metals today. Gold sitting at $17.01 per ounce. Silver at $18.05 per ounce on the ask side. They're holding into these support numbers, $1,700 for gold, $18 per ounce for silver. I don't know, guys. It looks like this strong dollar is just going to keep pushing metals down a little bit. So if you're a metals person, you're looking to add to your position, your opportunity is likely coming. Down oil today, also down, small down. West Texas Intermediate settling at $86.82 per barrel. Natural gas had a pretty bad day today, down to 809 per their million British thermal units, down almost 8%, which is funny to me because it's also a day that Russia cut the gas off completely. You would think demand would spike a little bit. Apparently this, I don't know if this is profit taking or something else in the market. We'll get into that over the next couple of days and see how this natural gas market progresses. Bitcoin also down almost $1,000 today. Looks like it's going to test that support number at 18,500. I was looking at the charts to see where it goes. If it breaks through that support number, Bitcoin could really have some issues. I think the next support line will be about 15,000, and below that about 12,000. Hold on to your hats, Bitcoin people. Hopefully it's going to develop a little support around this 18.5 and bounce like it did last time. Hopefully that's what we're going to see. We'll keep you guys informed daily. As always, at the beginning of the week, we know we have big data coming this week. Starting tomorrow, we'll get the Mortgage Bankers Index, which will just tell us about a lot of misery in the mortgage business. We'll get the trade deficit numbers, which will be interesting to see whether this strong dollar has any impact on our trade deficit. On Thursday, we're going to get a big one. We get the consumer credit numbers. Remember, we've been talking about this on the show last month. Consumers borrowed $40 billion. So it'll be interesting to see if the borrowing pace kept up as strongly in August as it was in July. I certainly hope not, for the sake of the American consumer. Also on Thursday, we'll get initial jobless claims, which will show us I'm believing will show us a strong job market, putting big pressure on the Fed to keep those rates going up, up, up. On Friday, another report coming. We'll get wholesale inventories. We'll see if wholesalers have been able to get some of these inventories out of their warehouses into these stores. Hopefully the numbers will be good. Hopefully we're going to get some good news somewhere on this stuff, because it seems like it just keeps getting worse, guys. I mean, we've known this recession was coming. We've started talking about it pretty much from day one on this show back in June. But now it looks like, and we talked about it, I use these analogies, as you guys will remember. I talked about the snowball rolling down the hill, picking up speed, getting bigger and bigger. And it looks like it's starting to happen, not only in real estate, but throughout the entire economy, except for jobs. Looks like companies still want to be hiring, even though we read about big layoffs at major corporations every day. But apparently, well, people still want to hire. Maybe it's small businesses, mom and pops, medium-sized corporations, I don't know, but we'll see what jobs look like on Friday. It's going to be a very interesting week for data. News you guys need to hear about today. As I mentioned when I was talking about bonds earlier, we are entering a bear market in bonds. This is the first time this phenomenon has happened since they actually instituted this Bloomberg Global Aggregate Bond Index in 1990. We've never had a bond market, bear market, however you would say, bear market in bonds, since they've instituted this Bloomberg Index. So this is something new for most people in this market. And truthfully, this is probably the first bear market in bonds going back to the mid to early 80s, when the Volcker was finished with his rate increases, and now we enjoyed 35, almost 40 years of rate cuts and low interest rates. Now it looks like it's time again for harder, more expensive, less easy to come by money. A bear market in bonds, man. Crazy, crazy stuff happening. I was reading, it said New York University says that this is the worst year for fixed income, bonds, corporate treasuries, whatever, since 1928. So bonds are typically, the bond market is kind of the boring place, right? It's where the market, numbers don't gyrate all over the place. You buy a bond, you kind of put it away, you collect your, you get your interest every quarter. Now it looks like the bond market's going to be as lively as the stock market is. A bear market in bonds. Wow, not good news for the stock market, kids. Not good news at all. Also, in information you guys need to hear today, Bank of America coming out with warnings of a recession shock coming here for the United States. They're warning that there will be, here's the quote, new highs in yields and new lows in stocks. This is nothing new to anybody that's been watching this show since we started it. We've been kind of predicting all of this stuff would be happening. Now it's really starting to pick up steam though, guys. So the stuff we've been recommending to you guys all along since we started this show: save your money, invest conservatively, try not to take on new debt. If you have the ability to pay down some of the debt you have now, do it. Spend your money prudently, be conservative, be thoughtful spending your money. Do the things you have to do, but on this discretionary stuff, it's a much better time to be a saver right now than it is a spender. These things are all meaning more and more and more as we move deeper into this recession, guys. Get prepared. There's going to be debt traps springing up all over the place for people to jump into. There's all kind of crazy stuff talking about. Europe today, which is kind of leading the parade in this recession. Well, Russia now has cut off the gas supply out of this Gazprom pipeline completely. They're saying that because of sanctions in the West and blah, blah, blah. Bottom line is they're weaponizing natural gas. Europe's freaking out. Our friends in England today, elected a new prime minister, already talking about price controls coming up for energy. Price controls usually don't work well, at least in the long term. This is going to cost the British government a lot of money to subsidize everybody's power bills. As we've talked about on the show, the price caps in Great Britain end in October. Great Britain is looking at price increases on energy for consumers of up to 80%. Well, the government's trying to get in front of that with these price controls. We'll be talking about that, and we'll see how that plays off over the next months going into October and into the winter with natural gas. Also, I talked last week about Michael Burry's prediction that the super bubble we're in here with housing, the stock market, the bond market, and everything bubbling is going to crash pretty bad. Well, now another market guru, Jeremy Grantham, and this guy's no slouch either, guys, okay? He says the super bubble in the United States is about to pop. And he cites rising interest rates, terrible inflation, food and energy crisis, ongoing wars all around the world, as well as longer-term issues here in the United States, such as labor shortages and an aging population relying on government for Social Security and expenses. Here's the quote from Mr. Grantham. He said, "Each cycle is different and unique, but every historical parallel suggests that the worst is yet to come." Now, this is no slouch. This guy runs a company that manages $70 billion, okay? So this is not some small-time guy. Just like Michael Burry, another guy who's been around for a while, has a pretty good track record predicting this stuff. Guys, it's here. The storm is here. We can see the clouds above us now. We can see what's happening. I really ask you guys, please, consider what we're saying here. Take it seriously, guys. There's going to be a lot of adjustments. And when we have a storm like the one we're going to have here, when we come out the other side, things are going to look a lot different than they did heading into this storm. So we know some stuff that's coming up. We know real estate prices are going to correct. So that's going to wipe out a lot of people's home equity. We know the stock market's going to correct. It's already started to bear market, not bear market, whatever. People that look at their statements and their 401ks are shocked by the numbers they're seeing. We know that's going to continue to get worse. Now we know we're in a bond market a bear market in bonds, however you say it. It's a weird tongue twister. So we know that fixed income people that are owning bonds right now, are going to lose money on these bonds as rates continue to rise. This is all really, really, really bad stuff, guys. We've known this is coming. We've had a little bit of time to prepare. I just hope that everybody's ready to hunker down, because this is going to be some very, very, very difficult times coming up. When it's all said and done, the middle class is going to be shrunk. Imagine now your 401k getting hammered, your home equity getting hammered. If you own bonds and interest-bearing stuff, that's getting hammered. Basically everything getting hammered, except what? I mean, if you look at today, another one of those tantrum days in the market where everything is down. Stocks, bonds, precious metals, oil, cryptos, Bitcoin. I mean, where's the shelter? I guess in converting everything into dollars, I don't know. This dollar index being this high, I don't think this is a phenomenon that's going to last forever either. It's just a very, very, what's the right word here, guys? It's a very unique situation we're in here. This is not going to be your run-of-the-mill bear market. It doesn't look like. It looks like this one's going to be pretty dramatic, guys. So again, take care of yourselves. Take care of each other. Be prepared for the worst that's yet to come. Might not be a bad idea, as we've recommended in the past, to stock up on some non-perishable stuff, canned and foods that are durable and can last for a little while. We know we're going to have some energy shocks depending on where you are in the United States. prepare for the worst, guys, because it certainly seems like it's coming. Now, this week's going to be an interesting one. Maybe the Fed gets a little bit of a breather if, the consumer credit doesn't go as crazy and people aren't borrowing as much money, or the job numbers don't come in so great. We'll see where it goes. But in the meantime, the defensive positions we've recommended: utilities, healthcare stocks, dividend-paying stocks, food, soap, that kind of stuff, preferred stocks, having a portion of your portfolio, 10 to 15% of your portfolio in precious metals. All of these things are good advice now. Were good advice when we gave them a couple of months ago. We know now people are stampeding out of growth stocks into dividend-paying stocks. So if you've positioned yourself that way when we first started talking about it in June, your stocks, unlike a lot of this market, are probably not getting torn up so bad. So hopefully the advice we've given has been useful to you guys. We're going to try to stay on top of this as it develops. It looks like things are picking up speed now, so make sure to tune in every day to get your daily idea of where we at and where we going. Anyway, that's what we have for today, guys. We appreciate your support. As always, if you like what you're hearing on the channel, hit the like button. Share the video with your friends and subscribers. Of course, ask your questions in the comments. If you have a more in-depth question, email me at askchuckbarone@gmail.com. A lot of stuff coming up this week, guys. Until we talk again tomorrow, take care. Thanks.